Some of the smartest money on Wall Street is betting everything on AI right now, and a growing group of veterans thinks they are walking straight into a trap. The numbers behind the AI boom are starting to look shaky in ways that should make anyone pause. This video lays out 7 warning signs that the AI stock surge may be a bubble, the argument on the other side, and what it could mean for the wider market. And the first warning sign is hiding inside deals that look like growth but maybe something else entirely. Before going further, a quick and honest note. This is not financial advice, and nobody can predict exactly when or whether a bubble pops. The point here is to lay out the signals that careful investors are watching, so you can think clearly instead of following the hype. With that said, here is the case the skeptics are making. Warning sign 1 is circular money. Picture a tight circle of giant companies all funding each other. One famous chipmaker agreed to pour tens of billions into a leading AI company, and that AI company then uses the money to buy chips from the very same chipmaker. Similar loops run through cloud providers and data center builders, with the same dollars cycling between a handful of firms. Supporters call it locking in supply. Skeptics call it a mirage, because money moving in a circle can make sales look huge while little fresh value enters from the outside. Warning sign 2 is the gap between spending and earning. One top AI lab has talked about spending hundreds of billions of dollars on computing power over the next several years. Now compare that to its actual revenue, which is a small fraction of those plans. Across the industry, the biggest tech firms are pouring hundreds of billions into AI build-out, while the money customers actually pay for AI products is far smaller. When spending races ahead of real income for years, something eventually has to give. That brings up warning sign 3. The sell-off has already started at least once. Earlier in 2026, a report suggested one major AI company was missing its internal revenue targets. The reaction was instant. AI infrastructure stocks dropped, with chipmakers and cloud names sliding together in a single day. It was a small tremor, not a collapse, but it showed how jumpy the market is, and how fast confidence can wobble when the growth story gets questioned even a little. Warning sign 4 is dangerous concentration. So much of the recent stock market gains rests on a tiny number of companies tied to AI. When a handful of giants carry the whole market higher, the market becomes fragile. If even one weak link in that chain stumbles, the damage can ripple outward and drag down far more than just AI stocks. A market leaning this heavily on so few names is a market with a thin safety net. Here is warning sign 5, and it may be the most important. The promised payoff is slow to appear. For all the money pouring in, many businesses that adopt AI are struggling to show real profit from it. Studies and surveys keep finding that a large share of AI projects deliver little measurable value so far. The technology is genuinely useful, but useful is not the same as wildly profitable. If the returns keep lagging far behind the spending, patience on Wall Street will eventually run out. Warning sign 6 is a physical wall, and it surprises people. All of this AI needs enormous amounts of electricity to run the data centers behind it. That demand is straining power grids, and in some places communities and local governments are pushing back against new data center construction. You cannot grow a digital boom without real-world power, water, and land. When the physical world cannot keep up with the digital dream, the dream hits a ceiling it cannot simply code its way around. Warning sign 7 ties the others together. The whole system is leaning on borrowed money and big promises. Companies are taking on debt and making massive commitments based on the belief that demand will keep exploding forever. Financial watchers are now eyeing the bonds and the credit of some of these players for cracks. If lenders start to doubt that the AI build-out will pay off, money can dry up quickly, and projects built on cheap borrowing can stall in a hurry. So is this definitely a bubble about to burst? Here is the honest other side, because a fair look demands it. Defenders of the boom argue the demand for computing power is real and still growing fast. They say the circular deals are a smart way to lock up scarce chips and build capacity quickly. They point out that AI is already changing how people work, and that the productivity gains may simply take a few years to fully show up in the numbers. By this view, the spending is an investment in a genuine revolution, not a fantasy. They also make a fair historical point. Bubbles are notoriously hard to time, and markets can stay irrational far longer than anyone expects. People have predicted the AI crash many times already, and it has not happened. The internet boom of decades ago was both a real revolution and a bubble at the same time. Many companies died, yet the technology reshaped the world. AI could follow that same messy path, where the long-term winners survive a painful shakeout along the way. So what should you take from all of this? A few grounded points. The warning signs are real and worth respecting, especially the gap between spending and actual profit. At the same time, real and lasting technology is also being built, so writing the whole thing off would be a mistake too. The smart move is not panic and not blind faith. It is paying attention to whether the money coming in ever catches up to the money going out, because that is the question the entire boom rests on. What would a pop actually look like for you? History gives a rough script. First, confidence cracks after a big miss or a scary headline. Then the most stretched stocks fall fastest, dragging the steadier ones down with them in a panic. Money that was easy to borrow suddenly dries up, and projects that only made sense with cheap cash get frozen. The pain spreads from the AI names into the wider market. Since so much of it is tied together, none of that is a prediction of timing. It is simply the familiar shape these unwindings tend to take. Does a pop mean AI was fake? Not at all, and this is the nuance that matters most. When the internet bubble burst long ago, the technology did not vanish, it went on to reshape the entire world. What got wiped out were the companies whose prices ran far ahead of any real business. The same could happen here. The strongest AI players may survive a shakeout and thrive for decades, while the weakest and most overhyped get washed away. A crash in the stock price is not the same thing as a failure of the technology itself. Here is the bottom line. Every great bubble in history looked like an obvious, unstoppable opportunity right up until the moment it did not. The AI revolution may be completely real and still be priced far beyond what the numbers can support today. Those two things can be true at once. The danger is never the technology itself. It is the gap between the story people are telling and the cash that story can actually produce. And that leaves one sharp question for you to sit with. If the entire AI boom is being funded by companies paying each other in a circle, what happens to the music the moment one of them decides to stop dancing? Like it, subscribe, and comment whether you think the AI boom is a bubble or the real thing.